JP Morgan Chase suggests that precious metals and precious metals related securities comprise less than 0.5% of all savings and investment assets in the United States. This is very important because they estimate that the 40-year mean market share was 2%. So gold doesn't have to, all these gold bug things, gold doesn't have to win the war against the US dollar. Gold doesn't have to supplant the US 10-year treasury. All it has to do is revert to mean. If the market share reverts to mean, demand for this asset class, precious metals and precious metal securities, increases fourfold in a market that right now is 23% of the world's savings and investment assets. That's all it has to do. That's precisely what it's going to do.
Gold continues to solidify its reputation as a reliable hedge against inflation and economic uncertainty, despite the focus on its nominal all-time highs. RickRule of Rule Investment Media emphasizes that while many celebrate gold's price milestones in dollar terms, the real significance lies in its ability to preserve purchasing power as fiat currencies devalue over time. This perspective highlights gold's fundamental role beyond speculation. It safeguards against inflationary erosion. The US dollar index remains below 108 as traders digest the Federal Reserve's latest policy decisions, and weaker than expected US gross domestic product data. Although the Fed remained unchanged, it notably removed prior references to inflation, making progress toward its 2% target. This shift has fueled hawkish speculation, reinforcing the case for gold as a safe haven asset. Former President Donald Trump's tariffs have unsettled equity investors, leading to a 1.87% drop in S&P 500 futures, now at 5,956 points. This market volatility drives investors toward gold, enhancing its appeal as an alternative currency. According to Rule, a typical precious metals bull market begins with gold leading the rally, primarily driven by fear and uncertainty. As investor confidence builds, silver historically assumes leadership, though the reasons behind this transition remain unclear. However, this recurring pattern suggests silver's potential to outperform during the latter stages of a bull market. Commodity analysts project that rising industrial demand, especially from the solar energy sector, will push silver prices to $35 in 2025 and $38 in 2025-2026. Due to its critical role in renewable energy and electronics, silver is expected to gain momentum due to its shrinking supply and increasing applications. Capital economics even predicts silver will outperform gold in the coming years, suggesting a potential for silver to take center stage in a precious metals bull market as economic conditions evolve. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, I'm going to push back on all-time highs. All-time highs in nominal value. And the difference between nominal value and purchasing power is what gold's all about. When people talk about $2,700 in a nominal value, they're talking about a floating abstraction for the denominator. And that's not right. I think it's really important to recognize that. Gold has done well through history, at least in my reading of history, but also in my life, which is long enough it's becoming history, that I've seen that gold does very, very well when investors and savers are concerned about the maintenance of their purchasing power in fiat instruments. If you believe the US government statistics, I'm a voter, I don't, they will tell you that the destruction of your purchasing power in US dollars is 2.6% compounded a year. If there's any Americans in the audience, aside from me, if you look back at the basket of goods and services that you've consumed in the period 2020 to 2025, this 2.6 number is fiction. I would suggest that the CPI is the CPI. Look at your health insurance, look at your health costs, look at your rent if you rent, look at your mortgage, look at your gasoline prices, look at your grocery prices, and tell me that the purchasing power of your currency has only declined by 2.6% compounded. I'm no economist, but this is laughable. Really, truly stupid. If John Williams were here, Shadow Stats, he'd say that U.S. inflation is 12% compounded, and say that the destruction of the purchasing power of the U.S. dollar is sort of 7.5% compounded. That's bad enough. But if you're concerned about the deterioration of your purchasing power, you have to put in one more piece of math. The predominant savings product in the United States, the predominant savings product in the world is the U.S. 10-year Treasury. That pays you 4.5%. So if you're earning 4.5 in a currency where your purchasing power is declining by 7.5, you are guaranteed to lose 3% of your purchasing power a year compounded for 10 years. Think about that. You give the U.S. government your money for 10 years, and they absolutely solemnly swear to give you 35 or 36% less purchasing power after 10 years. The first of their promises, by the way, in my life that I believe. And that's why I think gold is going to do well, right there. Precious metals bull markets are led by gold. The first buyer is a fear buyer. I get that one. At some point in time, when the narrative achieves enough currency with generalist investors that the generalist money comes in the precious metal space, leadership changes from gold to silver. I've been trying to figure out for 50 years why, and I don't know. So I'll just say I don't know. I don't know why, I just know that. And when that transition happens, silver moves much faster than gold. And the last asset class in the continuum is the silver stocks. There's a small enough market cap of the high quality stocks that 3 times in my career, when the generalist money comes in the space, the silo, the combined market capitalizations of the silver stocks can't handle the money that comes in. Now, the Canadian dealer network fixes that after 3 or 4 years. They print more phony certificates than anybody could possibly buy. But at the beginning of that, I mean, you see moves like Silver Standard, 78 cents to 45 bucks. Pan American Silver, 50 cents to 45 bucks. When I was a kid, Coeur d'Alene, 10 cents to 65 bucks. It's truly spectacular. Ask her why, and just ask me to give you an old man's reflection on what.
The disconnect between rising gold prices and the lagging performance of gold mining stocks can be attributed to the differing investor bases for each asset. RickRule points out that while central banks have been major buyers of physical gold, they do not invest in mining stocks. This distinction highlights the divergence between the two markets despite their intrinsic connection to the same underlying asset. Gold stocks are near a 37-year low relative to gold prices, even as the metal flirts with new all-time highs. In contrast, gold mining equity ETFs, such as Sprott Junior Gold Miners, remain at levels similar to those in previous years. Now approaching a decade, the fund has faced challenges alongside the broader gold equities market. Although it recorded gains exceeding 20% last year, its performance still lagged behind gold in 2024. This persistent gap between gold's price appreciation and gold mining stocks suggests a potential investment opportunity heading into 2025. A major factor behind mining stocks' underperformance has been higher than expected cost pressures. While these challenges persist, the surge in gold prices over the past year has made gold miner valuations extremely attractive. With gold trading near record highs and miners still undervalued, there is growing speculation that the market may soon recognize the disconnect and close the valuation gap. Let's get back to the interview.
The disconnect in the move between the metal and the miners is easy to explain. The metal has moved because central banks have been buying the metal, and the central banks don't buy mining stocks. They're related markets, but they're not the same markets. You know, I'm looking out here, and I was looking around for any central bankers, and it seems they're missing. So the idea that there's 2 different buyers classes in a related asset class explains most of the difference. The rest of the answer is not so pretty, frankly. If you dial the precious metals equities market back to the year 2000, in the period 2000 to 2010, the gold price increased 7-fold, and the free cash flow per share of the major miners decreased. It took real skill to turn a 7-fold increase in the selling price of your product into reduced free cash flow per share. So industry investors and generalist investors, let's just say they've had low expectations around the efficiency of the mining industry. I believe that investors, at least for the next 2 or 3 years, will hold the industry into account. The third circumstance is that as the gold price increased, the price of inputs, or the cost of inputs increased too, so that the margin expansion that some investors expected the gold industry to show in the last 3 years didn't occur. Maria and I have the advantage of having been around a while, and we understand. And just looking very recently at the quarters that you saw at Lundin Gold, Alamos, Agnico Eagle, what you're starting to see just now is gold companies that aren't beating their quarterly forecasts. They're murdering them. They're clobbering them. In other words, to say, I think that's going to follow. But I want also to answer your previous question. Actually, anyway, the math that's important to me around future participation in this market is that the market share in the United States of precious metals and precious metals related securities relative to other savings and investment classes is less than 0.5%. JP Morgan Chase suggests that precious metals and precious metals related securities comprise less than 0.5% of all savings and investment assets in the United States. This is very important because they estimate that the 40-year mean market share was 2%. So, all these gold bug things, gold doesn't have to win the war against the US dollar. Gold doesn't have to supplant the US 10-year treasury. All it has to do is revert to mean. If the market share reverts to mean, demand for this asset class, precious metals and precious metal securities, increases fourfold in a market that right now is 23% of the world's savings and investment assets. That's all it has to do. That's precisely what it's going to do. I can't give you a gold price target because I'm not that smart. All I can try to say is that if an asset class where you can't increase supply very much goes from a 0.5% market share to a 2% market share, it has the potential to do absurd things to price.
As gold continues to assert its role as a safeguard against economic uncertainty, its divergence from mining stocks presents an intriguing dynamic for investors. While the metal reaches new milestones, mining equities remain undervalued, hinting at potential opportunities for those who navigate the market's complexities. Meanwhile, silver's industrial demand and tightening supply position it as a strong contender for future gains. With shifting monetary policies, evolving geopolitical landscapes, and growing investor interest in tangible assets, the question remains, will the broader market recognize these trends in time, or will opportunities be left on the table? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.